On June 12th, SpaceX went public. Biggest IPO in history. Bigger than Saudi Aramco. Bigger than anything Wall Street had ever priced. For about 48 hours, the stock ripped so hard that Elon Musk briefly became the first trillionaire in human history, and SpaceX was worth more than Amazon. Then it just stopped, started sliding, kept sliding. And as of this week, the stock is knocking on the door of the exact price it opened at a month ago. Basically, every dollar of gains gone. On a company that's still losing billions a year. So here's the question nobody's answering properly. Was that an $86 billion vote of confidence in the AI age? Or the first crack in something much bigger? Every time this comes up, people split into two camps. Camp 1, AI is a bubble. It's 1999 all over again. Sell everything. Camp 2, AI is the biggest breakthrough in a generation. The numbers are real. Get in now or miss out forever? Both camps are arguing about the same thing without realizing it: demand. How many people use ChatGPT? How much revenue OpenAI makes? Whether Nvidia's chips are actually being used or just stockpiled? Demand is loud, it's emotional, and honestly, it's the easiest number to spin a story around. But there's a second half of this equation that almost nobody talks about, and it's the half that actually tells you what's coming next. Supply. How much money is being poured in, by whom, and under what terms? Supply is boring. Supply is spreadsheets and debt filings. But supply is also honest in a way demand never is, because it takes real capital committed today that has to be paid back regardless of how the story ends. Quick reset, because bubble gets thrown around so much, it's lost its meaning. A financial bubble isn't just prices went up a lot. It's when the price of something detaches from what it can realistically earn you, because everyone buying it is betting the next person will pay even more, not because the underlying business changed. And here's the part that surprises people. Bubbles don't need bad technology to happen. Railroads were real. The internet was real. Electricity was real. Researchers have found that across roughly 175 years of major breakthroughs, the majority eventually triggered a serious speculative bubble anyway. Good tech and bad investing are not mutually exclusive. In fact, they tend to travel together, because genuinely transformative technology is exactly what makes investors stop asking hard questions. So if demand doesn't tell the real story, what does? A concept called the capital cycle, and it runs in 4 stages. Stage 1, the flood. Money pours into an industry because the story is irresistible. Stage 2, the boom. Everyone builds at once. Capacity explodes. Competition is easy because there's more demand than anyone can serve. Stage 3, the collapse. Supply catches up to demand, sometimes overshoots it. Margins get crushed, and the weakest players go first. Stage 4, the inheritance. The survivors, the ones with actual cash flow, not just a good pitch deck, pick up the pieces cheap and quietly become the next generation of winners. Your returns as an investor are decided by where you show up in that cycle, not by how exciting the technology sounds on stage 3. So where is AI right now? Look at the spending. Corporate AI investment topped $500 billion globally last year alone, on top of well over $1 trillion in the years before that. The big cloud players are now running combined annual infrastructure budgets in the hundreds of billions, funded increasingly not by cash on hand, but by fresh debt. Nvidia, the company every AI bet ultimately runs through, sold tens of billions in bonds this year for the first time since the boom started. Meanwhile, the companies actually building the models are bleeding money to stay in the race. OpenAI has committed to spending well over $1 trillion on data center capacity over the coming years, against a fraction of that in current revenue. That gap, massive committed spending, comparatively tiny revenue, is the single number that matters more than any user growth chart. And now the credit markets, which are usually the last ones to panic, are starting to twitch. Spreads on tech company debt have been widening. Chip stocks, Micron, AMD, Intel, have taken brutal one-day hits on nothing more than soft guidance. When a rounding error in a chipmaker's forecast can erase hundreds of billions in value across the sector in a single session, that's not a market pricing in steady growth. That's a market priced for perfection, where there's no room left for anything to go wrong. Which brings us back to SpaceX. The IPO wasn't really about rockets. It was a test of whether public markets still had an appetite for AI-adjacent, capital-hungry, not yet profitable companies at eye-watering valuations. For about 2 days, the answer was an enthusiastic yes. Then reality. Insider lockups starting to expire, a brand new bond offering, a company still posting multi-billion-dollar losses, caught up with the price, and it's still catching up. OpenAI and Anthropic have both quietly filed paperwork that could put them on a similar path. If SpaceX is the preview, the reception won't be simple. It'll be exactly what the capital cycle predicts. A flood of enthusiasm, followed by a much harder conversation about whether the math actually works. None of this means AI isn't real. It clearly is. These products generate actual revenue in a way the dot-com companies never did. And that's a real difference this time. But real technology and correctly priced are two completely separate questions. And right now, the market is only answering one of them. So next time someone tells you AI is or isn't a bubble based on how many people are using it, remember, that's the noisy half of the story. Watch where the capital is flooding in and watch where it starts quietly leaving. That's the half that doesn't lie. If you want the next one, the part where we talk about who actually gets left holding the bag, subscribe. It's already loading. The pioneers take the risk. The ones left standing after the shakeout take the market.